Very good morning to all of you. Welcome to another YouTube live session with me, Surjit Kakar. Today is Sunday, 15th of September 2019. So, today we will be talking about how to start trading. Now, this is a very important topic. This is something which I almost repeat during my uh, the POS Plus course with a lot of students because almost every other day new students are joining in, and what I need to do is I again have to explain them what is the process, how they should be going about it. So I thought, why not to do a YouTube live session where I'll just create it as a video, and then I can point everyone to watch that video, because this is where everybody, I'll say not everyone, but majority of the people, they start going wrong. And you need to understand that there has to be a process in place, and you will also understand today why there has to be a process in place. Now, the first thing I'll start with is that if in fact, what I'll say is almost everyone who starts learning trading, what they do is they start searching for that holy grail. They are looking for a system where they are making money on each and every trade. Now, this is something which I can guarantee you, that there is no such strategy in the world where you will be making money on each and every trade. Which means you have to accept it as a fact that you will be having winning trades and you will also be having losing trades. So if I will be having losing trades, what is the only way to be profitable? Now, if you talk about an outcome of any trade we are taking, so the outcome of any trade can be that a trade which gives you profit, which is a big profit, a trade which gives you a profit, which is a small profit, a trade which is a break even trade where it's no profit, no loss. It can be a trade with a small loss, and it can also be a trade with a very big loss. And these are the only five outcomes which can happen whenever you're getting into a trade. So we know that there is no way to avoid this, right? You will be having stopped out trades. But what is the best thing you can do? The best thing you can do is avoid big losses. And how can you avoid big losses? By having a stop loss. So as long as you have a stop loss, now your outcomes have changed into four different outcomes: a big winner, a small winner, a break even trade, or a small loser, but because of that stop loss, you'll never be having a big loser. Now, once you have taken care of this, the next thing you need to take care of is that even when you have your winners should be much bigger than your these losing trades. Because if you have big winners and you have small losers, even if you're right 50% of the times, even if you're right, let's say 40% of the times, you can still be a profitable trader, provided your reward to risk ratio is good enough. And I always suggest that whenever you're planning a trade, you should be having a reward to risk ratio of at least 2:1, which means if a trade show you at least twice the reward of the risk you're taking, only then get into a trade. Otherwise, don't get into a trade. Now, that being said, let's move on to the next step. Now, let's assume uh, uh, I toss a coin, right? Let's assume I toss a coin. So the very first time I toss a coin, I get heads. The second time I toss the coin, I again get heads. The third time again I toss a coin, again get heads. So does that mean that the probability of heads is 100%? Absolutely not. Right? Everyone understands that if you're tossing a coin, the probability of heads and the probability of tails, both of them is 50%. But how do I understand that? Because if you look at my sample size, which is just three tosses, based on my sample size, what I can see is that it's 100% heads. But everyone understands that's not the correct interpretation. I won't say the interpretation, but that's not the correct number, right? And the only way you see that is once you start having a bigger sample size. Now, what do we mean by a bigger sample size? Now, instead of doing this statistics by just tossing it three times, if I do it 10 times, if I do it 100 times, if I do it 1,000 times, if I do it 10,000 times, if I do it 1 lakh times, you will see the bigger the sample size would be, the closer I'll start getting to that 50% mark. Right? So the smaller the sample size, the more skewed it could be to the one side, which could be heads, which could be tails. But once I start making my sample size bigger and bigger, I will start understanding and I'll start seeing this clarity, that yes, the bigger the sample size, the closer I'm getting to that 50%. So that is what you need to understand, that first, whenever you are trying to understand something statistically, you need to have big enough sample size to understand that. You cannot do it on a sample size of 3 trades, or a sample size of 5 trades, or a sample size of 10 trades. Now, that is where a lot of traders, they go wrong, because what happens is they pick a strategy, right? What they do is they take the first 3 trades or the first 5 trades. After taking those 3 trades, 5 trades, let's imagine the first 3 trades are stopped out trades for them. They'll say, okay, this strategy does not work. Or the first 5 trades are stopped out trades. They'll say this strategy does not work. Or maybe out of 5 trades, 1 trade goes enough in their favor. 4 of them are stopped out. Again, they'll say the methodology does not work. So the first thing you need to understand is that whenever you are looking at any trading methodology, be that demand and supply, be that you're using something else, always start with a big enough sample size, because this is what you need to realize. Let me bring up an Excel sheet which I have created. This will help you having a better understanding. Now, even if you are being aggressive, I would still suggest that you should have a sample size of at least 50 trades. If you want to be conservative, you should be having a sample size of at least 100 trades, right? So that completely depends upon you, whether you want to be aggressive or you want to be conservative. So even if you're being aggressive, at least 50 trades is what your sample size should be. So let's take an assumption that I'm starting with a capital of 1 lakh rupee and I'm risking 1,000 rupees per trade, which means I'm taking a risk of 1% per trade. Now, what this Excel sheet does is it basically, I can input some values here, that what is my reward to risk ratio. So let's assume that I trade only for a 2:1. So the RR I'm looking for is always 2:1. And the next input is what is my hit rate. So let's assume that my hit rate is 50%. That if I take n number of trades, 50% of them, they get stopped out, and 50% of them, they give me the target. That is what I'm taking as an assumption. So what this Excel sheet will do is, you will see whenever I refresh it, it will randomly generate some results where out of these 50 trades, we'll have 25 winners, we'll have 25 losers, and then it will plot it graphically for me here. So what I'm doing is I'm just refreshing it just to create some random results, and I just want to find something which would probably not be a good start. So this is still fine, but let me see if I can find something worse. Again, it's generating randomly, so I have no control over it. So I'm just looking for a bad start, right? That is what I'm looking for. I'm looking for a bad start where probably you have the early start with a streak of losing trades, right? That is what I want to get onto. So I'm still refreshing it because, like I said, I have no control on this. It generates random results. And that is what I'm doing. Okay, it's still just 3. Let's see if we can get even worse. All right, so let's see if now it happens. Probably I won't refresh it more. It's still 3. Okay, this is good. So can you see what this was doing was it was generating some random results. Now, if let's imagine this was your starting point. If you would have started here, can you see your first trade is a stopped out trade, your second trade is a stopped out trade, your third trade is a stopped out trade, your fourth trade is a stopped out trade. Now, if you were only looking at a sample size of 5 trades or 10 trades, you will say, okay, out of 10 trades, already I've had 4 trades which have already stopped out. So this is a strategy which does not work, right? And this is the reason why you need to understand that bigger picture first. Now, if you look at that bigger picture, yes, I had my streak of losing trades, but then I had my streak of winning trades. Again, I had my streak of winning trades. Now look here, I had a streak of 1 losing, second, third, fourth, fifth, 6 losing trades in a row. And this is where you can see it. Can you see 1, 2, 3, 4, 5, 6 losing trades in a row? And this is where what happens is 2 things. One, we start losing our confidence in the strategy. We also start feeling, okay, this does not work. And that is why it is very, very essential for you to have a big enough sample size. Because now if you look at that big enough sample size, yes, I know I'll be having 25 winners, I'll be having 25 losers. What if the first 25 trades were all stopped out trades and the next 25 trades were all winning trades? That could have also happened as a exceptional case, maybe. That you have 25 losing trades and then you have 25 winning trades. But as long as your reward to risk ratio was good, can you see we were talking about a reward to risk ratio of 2:1. Even though we had those streaks of losing trades, but because of our reward to risk ratio being wrong 50% of the times, still we started with the capital of 1 lakh and we ended up with a capital of 1,25,000. Now, if my hit rate was even worse, let's say my hit rate was a hit rate of 40%, which means out of every 10 trades, 6 trades would be stopped out, which means now I have only 20 winners and I have more number of losing trades, which is 30. Still, you can see with the 1 lakh capital, you ended up 1 lakh 10,000, because what keeps you profitable is not the hit rate. What happens with me is almost every other day, whenever somebody contacts me or talks with me, the first thing they ask is, what is the hit rate of your strategy? And what I tell them is that if you're running behind the hit rate, you're trying to catch the wrong train. Why? Because you might be somebody who's taking a risk of 10,000 rupees just to make a profit of 1,000. Now, if you're doing something like this, you can have a hit rate of 90%, but the end result would be you're still in losses. Why? Because those 90 profitable trades, those 90% profitable trades would have given you, let's imagine I took 10 trades, then 9 profitable trades would have given me 9K, and one losing trade, I would have lost 10K. So I would be net in a loss of 1K. So can you see what good is this 90% hit rate when I'm not profitable at the end of it? And I'll be happy with doing something like this where I'm only right 40% of the times, but at the end of it, at least I'm making money. So that is what you need to understand, that the correct train which you need to try to catch is your reward to risk ratio. It's not the hit rate. If you have good reward to risk ratios, hit rates are irrelevant, right? That is how it is. Now, you might be somebody who's only planning trades for 10 is to 1s. Now, even if you're having a hit rate of 10%, yes, net you can be profitable. Right? So I'm just showing you as an example that why hit rate is much more important versus running behind. Uh, Hit rate is not very important. What is important is your reward to risk ratios. Now, let me also generate some random results for it. Now you can see, you had a losing streak, 1, 2, 3, 4, 5, 6 trades, but you also started moving up when you had some winners. And what again is keeping you net profitable is your reward to risk ratio. So even if you look at your PNL, your PNL graph would also be just like the charts you're analyzing. They will have their downtrends, they will have their uptrends, they will have their sideways trends, right? But you need to understand that you cannot gauge your performance based on a very small sample size, which is very, very important. So again, I'll add at least a sample size of 50 trades. If you want to be aggressive, if you want to be conservative, then at least a sample size of 100 trades. Now, once you have clarity to this, now we'll move to the next step, how to start trading. Right, because this is what I wanted to make it clear to you as a bigger picture, so that you can understand it. Because when you have that graphical representation, at times things they starts becoming much more easier for us to understand. And can you see, no matter what kind of results you get randomly, maybe it's starting with a good winners or starting with a lot of losers, but you will still see that over a big enough sample size, yes, there's things they again start falling back onto track. And now let's look at this example. If you were only taking a sample size of 10 trades, can you see your first 10 trades, you only had one winner, all other trades were stopped out trades. In fact, I guess two. It would be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So can you see, out of 10 trades, I only had two winners, 8 losers. So again, if I'm having only a sample size of 10 trades, you still can't understand that bigger picture, because you will say, okay, I have taken 10 trades. This is not working for me. And that is why it is very, very important to have that big enough sample size. Now let's move on to the next step. So once you have this realization that it is not about making money on each and every trade, it is all about having good reward to risk ratios and having a big enough sample size to start. What is the correct way to start, right? That is the next step I'll be going to. The first thing you have to remember is that whenever you are starting with your trading career or you're learning how to trade, do not start trading for money, right? So NEY is a big no. You don't have to start for making money. And this is where everyone goes wrong. Why? Because they believe, I have done a 30 days course, I've done a 60 days course, I've done a 1 week course, or maybe I have read a book and now I know the strategy, or I have got some strategy from the internet. This looks really, really nice when I'm doing the back testing. Irrespective how good it looks, first thing you need to understand, you don't have to start trading for money. What you need to start trading for is skills. You need to have the trading skill, you need to have the correct mindset, you need to have the correct tools, you need to have the correct approach. So first thing is, you need to start trading for skills. Once your skill is developed, I can guarantee you that money would be byproduct of it. But if you start trading for money, what is going to happen is very, very soon you will stop trading. Why? Because just imagine, if you are trading for money, and let's imagine you're taking a risk of 10,000 per trade. If your first 3 trades are stopped out, you will never gonna take the fourth trade. Why? Because Now you lost 30K probably in a day, and now you will say, okay, this does not work. Let me now look for another strategy, or let me now look for another methodology, or let me try to search for again the holy grail and find something else for me. So very important, you do not start trading for making money. You start trading first to develop your skills. I'll tell you how to go through this, but this is a very, very important part. Now, example I can give you, or analogy I can give you is, let's imagine a surgeon. Now, do you think once the surgeon is done with his, whatever medical education is, the very next day he goes to an operation theater and starts operating on somebody? Absolutely not. What do? They practice with a person who is already skilled, right? Who has been doing it for a number of years. They practice with them for 6 months, for a year, maybe 2 years, maybe 3 years. And after doing that, what happens is they gain that confidence, and after gaining that confidence they start doing the surgeries all by themselves. Take an example of a computer programmer. So just because you have learned coding, do you start programming the best software from the very next day? No. Right, probably you'll be working with some companies, you'll be practicing with them, or you'll be practicing by yourself, and then slowly and steadily you start making better and better and better programs. Let's take example of a pilot. Once he has done with his whatever his flight training courses, does he become a pilot the very next day? Absolutely not. What do they need to do? They have requirements that they need to do X number of simulated flying, they need to do X number of real flying, then they have to work X number of hours as a co-pilot. After that they become the main captain of the ship. So that is how it is. So can you see, in every aspect we understand that we are always going through that skill development time, but we forget that when it comes to trading. We believe, okay, I've just learned something, I'm the best trader now, all I need to do is just straight away start trading for money, which is incorrect. First is your skills. You need to develop your skills. Once you're done with that, then you can move to the next step. Now, how do I work for this? The way you work for this is you need to do it in sample sizes. Like I told you, let's imagine you're doing a sample size of 50 trades. So the first thing you need to do is always take the worst case scenario. Right? What is the worst case scenario? Let's take an assumption that yes, during my skill development time, or while I'm going through this process, now this will take different durations for different people, because the biggest challenge with trading is, yes, you need to have a good methodology, which is your 10% of it. You need to have a good risk management, which is 30% of it, but the 60% part is your emotions. So even if you have a good strategy, you have good risk management, if you're not good with managing your emotions, everything will go for a toss. And that is why it is very, very important to do the sample sizing. And like I said, for some of you it might take 2 months, for some of you it might take 6 months, for some of you might even take 2 years. And the problem is not that you don't have the right strategy or you don't have the right risk management rules. The problem could be you're still not getting comfortable with managing your emotions. So what happens is, yes, you have some rules, but when it comes to real trading, if the market is doing something, you get into emotions and you start going against your rules and you start deviating from it. Now, let's understand how to start. So let's assume I'll be having a sample size of 50 trades. And what I'll do is I'll take it as an assumption that, yes, I will be taking these 50 trades. And let's assume that all my 50 trades will be stopped out trades, right? So we are taking the worst case scenario that I'm taking 50 trades and all my 50 trades will be stopped out trades. So I've already taken that as an assumption. So now the next question would be, if all those 50 trades would be stopped out trades, what is the maximum amount am I willing to lose, right? So that is what you need to specify. So let's imagine I answer that, okay, I will be taking 50 trades and the maximum amount I want to lose if all my trades are stopped out is 5,000. I don't want to lose more than 5,000 rupees in the market. So now what do I understand? That yes, I am comfortable with losing 5,000 rupees if all my 50 trades are stopped out, which tells me that per trade, I should be taking a risk of 100 rupees. And that would be a starting point. Now, can you see, when I'm trading with the risk of 100 rupees, I know a 2:1 might give me 200 rupees, which might not even help me buy a dinner for me. But again, can you see, we were not trading for money, we were trading for skills. So when I'm doing that risk of 100 rupees, what I have done, one, I will not be scared to take the next trade and the next trade. Why? Because I've already taken assumption that even if 50 trades they are getting stopped out, I'm not losing more than 5,000. So like in this case, when I said if the first trade you lose 10,000, the second trade you lose 10,000, the third trade you lose 10,000, you will be never be moving to the fourth trade. But here what will happen? First trade you lose 100, you will still take the second one, you'll still take the third one, you'll still take the fourth one, you'll still take the fifth one, you'll still take the sixth one. Why? Because you've already predefined this. Now if this is even a big loss for you, or maybe something which you're not comfortable with, whatever your amount is, you can start with that. So I'm just giving as an example. Maybe your amount might be that I just don't want to lose more than 2000 rupees divided by 50, which is 40 rupees per trade. So instead of taking a risk of 100, now you can start taking a risk of 40 rupees per trade. But you need to understand that this 40 rupees is not for making money. This 40 rupees is for developing my skills. And if I talk about it, uh, if you're taking a trade with a risk of 40 rupees or 100 rupee, or if you're taking the same trade with a risk of 10,000 rupees or 20,000 rupees, this does not imply that you're taking 10 times or 1,000 times the risk, so you're getting 10 times or 1,000 times uh, more skills. The skills which you're acquiring is exactly the same, be that a risk of 40 rupees or be that a risk of 10,000 rupees, be that a risk of 100 rupees or be that a risk of 20,000 rupees. So skill you're acquiring is exactly the same. So why to lose more to acquire that skill when I can lose less and get the same skills? Right. And yes, what is also going to happen is if you're losing more, probably you'll not be acquiring skills, you'll be acquiring fear. Right. That is what would be happening. So don't try to start with this perspective, which I know a lot of people, they don't do. That is how you need to start. So yes, once you go through that sample size of 50 trades, what is going to happen is, one, you'll start seeing the bigger picture, that it's not about making money on each and every trade. It's all about having good reward to risk ratios and taking trades for good reward to risk ratios. Two, even after going through that sample size of 50 trades, let's assume you're not getting the desired results. Now, if you're not getting the desired results, at least those 50 trades have given you some experience. And now, based on that experience, you can modify your trade plan, that maybe this is something which I'm doing incorrect and this is how it should be done. Or maybe, I was being aggressive. Let me add some conservative rules and let me do something like this. So what is going to happen is this will give you some experience. Based on that, maybe when you started first, your trade plan was version 1. Now, again, I'll add, even when you're starting with this, make sure you're starting with this when you have a complete trade plan for you. Now, what do I mean by trade plan? That you have a step-by-step complete process, which is more like, if this, then this is what I'm going to do. If this is happening in the market, then this is what I'm going to do. So it has to be a clean rule-based trade plan which you can apply to each and every trade. So it should not be something like that you're taking 50 trades. For the first trade, you're doing something else. For the second one, you're doing something else. For the third one, you're doing something else. For the fourth one, you're doing something else. Then again, you are basically defeating the purpose of going through this exercise. First thing is, you need to have a trade plan which is consistent, and to all these 50 trades, you have to apply the same rules over and over again, over and over again, over and over again. You cannot deviate from those rules. The reason is because if you're deviating from those rules, you're not able to gauge your performance, because first time you do something else, the second time you do something else, the third time you do something else. How do you know which one is working for you, which one is not working for you? But if I'm applying the same rules over and over again for every trade, at the end of it, by doing 50 trades, now I understand whether it is working or not. Why? Because I've been following the same rules consistently. So let's imagine after doing those 50 trades, you don't get the desired results. Now what do? You make modification based on your experience. Maybe this was version 1 where you did your 50 trades. Now go to version 1.1 where you make some modifications based on your experience. Again, do a sample size of 50 trades, right? Again, go through it, check whether you get the desired results or not. If you're still not getting, go to, again, make modification. You go to version 1.1, 1.2. Now, what can also happen is, maybe after doing this, you might realize the trade plan which you're following or the methodology you're following is not competent enough to keep you profitable. So what might happen is, maybe instead of moving to a version 1.1, you might have to look for a different strategy, right? So that can also happen. So that will also give you the clarity whether the methodology you're following is competent enough to keep you profitable in the markets or not. If yes, where those modifications can be done. And even after doing that, if you're not achieving the results, maybe you'll still have to look for a different strategy. So can you see, this starts making it easy for you to understand where to make modifications, where not to make it, understanding that bigger picture. And probably what is going to happen is, what I have seen is, generally once you go through the sample size probably twice or thrice, I won't say that it is required to be done maybe 5 times, 6 times, 10 times. uh, on average, I'll say you go through it twice or thrice through this exercise, provided you have a good enough methodology, right? So provided you have a good enough methodology. So once you do that twice or thrice, yes, now you reach a point where you are seeing that bigger picture. Plus, you're also getting the kind of results you were looking for, right? And now, once you are done with this, now is the step to move to. Now is just give me 1 second, please. Just give me 1 second. Right. So apologize for that. So yep, what I was saying was that once you go through this probably twice or thrice, provided you have a good enough methodology, you will reach a point where you will start seeing the results you expected, right? Or the kind of results you wanted. Now, once you start seeing those results, let's imagine you started with a risk of 100 rupees, which is where you were going through your skill development time. Now, what do we want to do next? We want to make money, right? So because now my skills are developed, I have seen things working for me. I have seen things giving me the kind of results I'm looking for. Now I want to make money. Now, what will happen is if from 100 rupees you straight away go to 10,000 risk or 20,000 risk, what you'll realize is that all of a sudden everything again goes for a toss, right? So that is what is going to happen next. Everything will start going for a toss. Why? Because the emotions which were involved when you were doing a risk of 100 rupees would be very different compared to the emotions when you are taking a risk of 10,000 rupees or 20,000 rupees, because at the end of it, the more money is involved, the stronger the emotions are. That is how it's going to be. So what you also need to do is from 100, you straight away don't jump to 10,000 or 20,000 or 50,000 or whatever it might be. You also have to make that progression slowly and steadily, right? So how do you have to make that progression slowly and steadily? That let's imagine from 100 I move to 500, right? Then I move to 1000, then I move to 2.5k, then I move to 5k, then I move to 10k, right? Then maybe 15, right? So depending upon your capital, whatever, right? So that is how you'll have to make that progression. So this is also very, very important, that once your skills are developed, do not jump straight away to maybe a very big risk. You will again have to go slowly. And why do you need to go slowly? Because you need to learn how to control your emotions. Because when you were taking a risk of 100 rupees, even if you had six losing trades, you will take the seventh trade. But if you're taking a risk of 10,000 rupees, you have six losing trades, probably even after three trades you'll stop. So that is why once you go through these baby steps, right, from 100 to 500, then to 1000, then to 2000 to 2.5k. So what is also happening is you're training your mind to understand how to be calm and how to remain consistent with your approach, and you're just looking at these numbers as numbers versus looking at these numbers as emotion. Because at the end of it, money definitely, wherever money is involved, emotions, they start coming into play. So as long as this is making you getting into emotions, it's going to be very, very challenging, right? So what you should be looking them as just numbers, right? Not as an emotion. And that is what the biggest challenge is to overcome when it comes to trading, that you have to disconnect yourself from the emotions which is connected with money, which definitely takes a lot of time. So that is how you need to progress, right? Start with that sample size of 50 trades, do it once, do it twice, do it thrice, do it as many times as it is required, unless and until you are getting the desired results and give you that confidence that your skills are now developed and now I can start trading for money. And that is how you should start trading. Anyone who straight away jumps into the market to make money, trust me, very, very soon they will be scared and probably they'll stop trading. And that is the process which I'll say not a lot of people they follow. And the people who follow this, yes, it's not a easy path. It is something which takes time. It is not something which happens overnight, because even to have that sample size of 50 trades, it might take you a month, it might take you 2 months, depending upon how aggressively or how conservatively you're trading. So you have to devote that time. If you talk about any profession you're into, right, there is no such profession where you learn it for 7 days or 30 days or 60 days, and then you are uh, the most experienced or the best person in that stream. It always takes some time. So you also have to understand here, also you have to devote time, you have to go through this process to start becoming better and better with the understanding, start taking control of your emotions, start understanding the whole picture, and that is how you progress. Now, I wanted to keep this session short and crisp, and we can see we're almost end of the half an hour, which is good, because if anyone is going through the video, it's not a very lengthy video they'll be watching. But what I'll do is I'll go through the Q&As, I mean the comments which I have in the chat box, and I'll quickly try to answer them. And once I'm done with that, then we'll end the session. And yes, everyone who is joining in, make sure you do follow this process. Do not start trading for money, right? Very, very important, very, very dangerous, not the right way to do. Start trading for skills. And like I always say, once these skills are developed, money would be byproduct of it, right? And this is the process you need to go through. So let's understand. Uh, let's check what all queries do I have in the comment box, in the chat box. Oh, so which one is better, demand and supply or trend line? So are you talking about the way to do the trend analysis? See, again, it's not that one of them is better, the other one is not good. Whatever you are comfortable with, you can start using it. The problem with trend line is that when we start drawing trend lines, you will generally see people will draw a trend line based on their biases. If you are in an uptrend, you would draw it in a way that it looks like an uptrend. If you feel it is in a downtrend, you will, or if you have a short position, you will draw it in a way so that it looks like a downtrend. So while we are drawing the trend lines, a little bit of emotions, they start to creep in. If you are doing moving averages, maybe those emotions are a little less. But again, the problem with moving averages, trend lines is that they are lagging. But yes, if you are using the way we do it, using the demand and supply zones, uh, again, emotions, they don't play any part, because we are only looking for where the zones are, which makes it much more easier for us. Plus, also, it can be at times something which is giving you the change in trend signal much before versus the other things they start showing you. So that can also happen. But again, there is no right way, there is no wrong way. The only way, correct way, is whatever is comfortable for you. And based on your trade plan, if your sample size is showing you it's working for you, you can always use that. Nothing wrong with it. But when we risk 100 rupees per trade, then position size is less. But when we trade this, the position size is big. So can we trade in cash segment with bigger amount? Yes, Sam, I'll completely agree with you that once you start increasing your risk, what is going to happen is the position size will start becoming bigger and bigger. So what will happen is when you're placing your orders, at times you will only get partial fills. You will not be getting complete fills if you are doing it in the cash market. So that is where it will become as a necessity for you to move from cash to maybe moving to futures, right? So that is something you'll have to do. But again, irrespective whether you're doing cash or you're doing futures, if your methodology is competent enough to keep you profitable, nothing is going to change, right? Now, if you look at the Sunday sessions, which I do, I apply the same strategy to Nifty and Bank Nifty, which are the Indian markets. I apply the same methodology to S&P 500, which is a US index. I apply the same methodology to commodities, which is now altogether a different asset class. I apply the same methodology to Forex, which is again a different asset class. So if you have a strategy which works, it should work irrespective what markets you're looking at, irrespective what time frames you're trading, irrespective whether you're doing intraday, you're doing position trade, you're doing swing trade, it should work. And that is the reason changing the segment will not affect it, right? It's just that if it is working for you, it will work everywhere. All right. So do you still maintain trade log? Yes, Rahul. So what we do is when we do our sessions, before the session starts, whatever trades which I have given in the past, if they get triggered, we definitely look into it. We discuss when the prices they came to the zone, whether it was tradable, whether it was not tradable, if we would have taken the trade, whether it was profitable, whether it was a stopped out trade. So we cover all those things. we actually review them. So it's not just a log, we review them every session, all the trades which are getting triggered. Can you elaborate on emotional with examples? Okay, emotions example can be you're in a profitable position, the position is going in your favor. Then all of a sudden, what happens? It starts coming back, and what you feel is okay, whatever is on the table, at least let me book it. Right. So, what is happening here? Based on your emotions, because you were seeing prices that started coming back and your profits were getting less, you closed your position. Another example can be you had three losing trades and now you're scared to place the fourth trade. That's another example of emotion. The fifth one can be that you've already taken, let's say, five trades, all of them were profitable. And now you are into an emotion which is called as overconfidence that, yes, can you see things are working in my favor? Let me take the next trade with a bigger risk and make more money on it. And what happens? The next trade gets stopped out. So emotions can be because of n number of things, right? It can be fear, it can be greed. Basically, it is driven by fear and greed only. But yes, emotions can be for deviating from your rules because of this emotion of fear and greed. On a number of steps it can happen. This session is very informative and really helpful. Thank you, Ansar. What should be the risk per trade out of capital? 1%, 2%? How many trades per day to begin with? All right, so AK, that's a very good question you asked. See, when you're initially starting, when I talked about how you should be starting with it, right? We are not bothered whether it is 1% or whether it is 2%. We are not even bothered about whether I'm taking all those 50 trades in one single day or whether I'm taking all those 50 trades in 10 days, right? So it doesn't make any difference. Why? Because you have capped your risk. Now, once your skills are developed and now you want to move to the next step, this is where you will start looking into these aspects. Now, what I say is a healthy number, which is what should be your risk per trade. Uh, if you want to start very conservative, you should not be risking more than 1% per day, right? So I'm just talking about per day. Now, even if you want to be a little aggressive, you should not be risking more than 3% per day, right? So being conservative, 1% per day, being aggressive, not more than 3% per day. Now, what is going to happen is once you go through the sample size of 50 trades, you'll get an idea that on average, how many trades you're getting per day. That is also one of the reasons why we need to do this. Because let's assume that you realize that I'm getting on average two trades per day. So what I'll be doing is because I know I don't want to risk more than 1% a day, when I start planning my trades, I'll be planning my trades with a risk of 0.5%, because now I understand that because on average I'm only getting two trades a day. So even if both the trades they get stopped out, I'll not be losing more than 1%, because initially you won't even know how many trades you'll be getting per day. Now, if your outcome was that you were getting let's say four trades a day, so if you were getting four trades on average per day and you don't want to lose more than 1% a day, you'll start taking risk of 0.25% per trade and you'll start taking your trades. Right. So initially it doesn't matter because you have capped your risk. But yes, when you're getting into trading for money, then you will have all this information with you that how many trades you're getting per day. Based on that, whether I want to risk less or I want to risk more per day, you can always divide per trade as well. What is the difference between money management and position size? See, money management would basically, I wouldn't say money management. I'll call it as risk management, right? So risk management will help you decide what would be the position size. Example, what people they generally do is uh, they do something like this. Every trade I'm taking, I'll be taking 1,000 shares. Every trade I'm taking, I'll be taking 1,000 shares, which is incorrect because different stocks will be at different price points. Doing 1,000 shares per trade is not the right way to do. The right way to do is that your risk should be constant. Your position size can vary. Example, let's imagine in this case, okay, let's say take a case, I don't want to risk more than 1,000 rupees per trade, right? So that is my risk appetite, that every trade I'll be taking a risk of 1,000 rupees. Now, if I'm planning a trade where my stop loss is 1 rupee, I can take 1,000 shares. If I'm planning a trade where my stop loss is 2 rupees, I'll take 500 shares. If I'm planning a trade where my risk is, let's say, 4 rupees, I'll be taking 250 shares. So can you see your risk remains constant, your position size would always be varying. That is what you need to do. So very important that your position size would always be based on your risk management. All right, so the explain the improved version of demand and supply indicator and more examples to also explain how to. So what I'll do is, Shubham, probably I'll take it in the next session because today's session I just wanted to dedicate to this one. So probably I'll try to do it the next session. A small request, please say something about your students who have become pro trader in the last 3 months. So Kabir, what I can basically do is, because generally what happens is, just give me a second. Uh, so what happens is we don't, uh, you know, track the log of our students, or we don't tell them to send our logs, right? So what happens is, only if they are sharing something by themselves on our, just give me a second, because we have a POS plus group specifically for our POS plus members. So if they send some feedback here, that is probably, maybe I can show you. So what I'll do is I'll just scroll up. So can you see, this is some of the interaction which has been happening in the morning. Now, if I go up and let's see if we have some feedbacks here, or some of the trades which students have taken and they're sharing it. Let's see. I can show you that because that is how it is. Let's see. Now, can you see he got a 9.6 is to 1 on this trade? So it's basically the reward to risk ratio, got a 9.6 reward to risk ratio, got 14.5. And you would also see that these trades, what I do is, we have a rule on this group that if you are sharing a trade, you have to share it before the trade has happened, not after the trade has happened. So these were the screenshots which he shared before the trade happened. That if you're interested in these trades, you can probably look into these trading opportunities. Got a 9 is to 1, 9.6 is to 1 on this, got a 14.5 is to 1 on this, right? If I go back and you see again, students, they are sharing their trading ideas. Let's also go back. Let me see if I can show you more. So that is how it is, just based on this interaction. Now, can you see? Okay, no, this is just a question. So this is not. Uh, Okay, so can you see this is a paper trade which has already given more than 5 is to 1. So 1 is to 5 is more like your risk to reward. When we call reward to risk, then it's 5 is to 1. So some people might be paper trading. Why? Because they don't want to even take a risk of 100 rupee or a 10 rupee when they can do it for free. Why not? So can you see sharing? I got a 5 is to 1 on this, got a 2 is to 1 on this. Right. So can you see got 2 is to 1 on this? Uh, Let me just show you. Uh, uh, got the fell today and the result in front of you, demand and supply rocks. So probably what he would have done is he would have already shorted the previous day. Today prices fell, and he's saying, demand and supply rocks. So, I'm just showing you some of these. So that is how I only get to know about the feedback. So can you see this one says I booked 1.5 is to 1, right? So yes, still acceptable. If you want to be a little aggressive trader, nothing wrong with that. But yes, can you see, this is how we get to know how probably students are performing. Got 2 is to 1 on this, got 2 is to 1 on this, right? So we don't tell people to share their trade logs or share something like that. Yes, if they are facing some challenges, they would definitely ask me during the sessions. That is where I help them. And yes, the way I get to know how they are doing is when they share these uh, messages in the group chat. That is where I get to know about it. So that's how it is. If supply and demand zones are violated again and again, can we what can we do, sir? So if it is getting violated, it's just a stopped out trade, right? So that is what it is, and that is what we started with. That every strategy will not be a profitable. I mean, every trade is not going to be a profitable trade. You have to understand it over a big enough sample size, and that is what we discussed. How to create that big enough sample size to understand that, right? So that's good risk management standpoint. Great. Thank you. You're welcome. Right. आपके students जो 3 months में successful trader बने थे, who which is very low time, so आपके students. All right, so Kabir is saying, if some of you just started and in a very short span of time, you are a consistent, profitable trader. So what I'll add is those of you who have done my course, if you had that kind of an experience that in a very short span of time, let's say 2 months, 3 months, you started having uh, the kind of results you were expecting. If you can share that, probably you can send us an email. What I'll do is maybe the next session, whenever I do, I can share their story with you, right? So probably what that is what we can do. I'll see if possible. Maybe, I can bring them online with me, and maybe they can use the microphone. They can share their side of it. That is also something we can do. So, Kabir, that's a good idea. What I'll do is probably I'll post it in the group. If somebody wants to share their story, maybe I'll ask them to send me any email or something like that, or maybe a small little video, and I can share it on my YouTube channel, which might be helpful to other people as well, right? So I'll definitely try to do that if possible. I took subscriptions for your classes on Learn app, have some doubts. So Shubham, if you talk about the Learn app, that is where we are only having the introduction to it, right? So it's not where we are getting into the complete methodology. So if you want to learn the complete methodology, you'll have to subscribe for the course. That is how it's going to be. Oh yes, sir. So the one you're talking about, yes, but that was a person who was long time back when I was working with OTA. So probably I'll ask him if he can share his feedback. Maybe I can do it, but again, he's not my student. I mean, he was my student, but I would prefer to share somebody's experience who have joined my POS or POS Plus course. That would be a better way to go about, right? Perfect. Kindly take online live help of alerts. So Deepak, what is going to happen is, when we do the simulation sessions, that is where I definitely talk about it. Q&A sessions, if students, they ask me, how it has to be done, I again take care of it. So, those are the things which are covered in the POS Plus group. It cannot be done on the YouTube live sessions. At times, demand and supply strategy has given a demand candle, but the next candle was given the supply candle. So how can we tackle this situation? So Abhishek, from your comment, all I can say is that you have still not probably understood how to identify demand areas and supply areas, because the way your comment is, it generally cannot happen, right? So if you have a demand zone, the very next candle cannot form supply, because we still need to have basing in between. So maybe a new supply is formed, the demand is violated, that can happen. Then it's simply a stopped out trade, nothing more. Uh, और इट्स कबीर मेरे पास वर्ड्स नहीं हैं आपका थैंक्स करने के लिए. uh, you see, again, what I always tell people is, at times students, even on the group, they thank me for the strategy and all. But I always tell them, see, they don't have to thank me. It's your hard work, it's your time, it's your effort which you're putting in. So all I've done is I've given you the right tools. I have shown you the correct process you need to follow. The analogy which I share is, example, if you join a gym. Now, if you join a gym, the only thing the gym is doing for you is it is giving you the right equipments. It is giving you the instructor who is telling you what exercises need to be done, what diet you should be following, right? All those things. So I'm also doing exactly the same thing. But if going to the gym, you are creating a very good physique, it was your hard work, right? I was not exercising for you, right? You were exercising for yourself. I just told you how to exercise. I just told you what equipment to use and how to use it. So you people are also doing exactly the same thing, and that is why I always tell people that you're joining my course. After joining my course, if you feel that you will be the best trader in the world, it's not going to happen overnight unless and until you do the hard work. So again, the same analogy: if you join a gym, you don't do that hard work, you're not going to get that physique. To get that physique, you need to do that hard work. You need to control your diet. You need to go to the gym regularly. You need to take proper rest. You need to do all these things. Similarly, I gave you this complete process. If you're not doing this process and the end of it, you tell me, okay, Sujit, I have done your course, I'm not making money. You have not followed my instructions. So unless and until you follow my instructions, how would you get those results? So that is where the problem is. At times people will say, okay, we have done it, but we are not getting results. Now, if I tell them, okay, show me your sample size of 50 trades, they won't even have a sample size of 5 trades. So when you have not done your homework, how can you expect to have the results? Same thing, if you are not going to the gym, how can you have a good physique? It's not possible. So similarly, here also, it's not possible. Without going through this process, you can start getting results. Not possible. Now, some of you, what is going to happen is, just like I'm pretty sure all of you would have had this experience. You take the gym subscription, you have that commitment for a week, maybe for 2 weeks, maybe for a month. From the second month, you're too lazy to do that, right? You give it up. Same thing will happen here, because it's not a cup of tea for everyone. Some people will be in sync with it, some people will not be in sync with it. Why? Because money is involved, and like I said, wherever money is involved, emotions are involved. So some people might be able to hold on to or control those emotions. Some people would not be able to. Some people will quit in between. at least you will understand that it's not your cup of tea. And now instead of losing a lot of money in the market, at least you limited your risk and you limited your losses, and you understood it's not your cup of tea, and probably you gave it up. And some of you would understand, okay, this is my cup of tea, I really love it, right? Same example, some people, they love going to gym. Some people think, how can they do that? Because different people, different personality styles. Now if you talk about me, have been exercising regularly for over 10 years now. And the day now, once you start doing something on a regular basis, now the day you don't exercise, it feels like you're missing something. And that's how it is. So some people will have that dedication, some people will not have that. But I just wanted to cover how to start it in a very correct way versus, people getting into it the wrong way. Right? And let's look at the last queries. Students. सर सब आपके ही स्टूडेंट्स हैं, चाहे एक्स ओ टी इंस्ट्रक्टर्स और करंट ओ टी इंस्ट्रक्टर्स, सबके टीचर तो आप ही. See, it's not that कि मैं सबका टीचर हूँ. I also learn from somebody, right? So it's just that whatever we are learning, we are just passing on to someone. Yes, I know there are quite a few instructors who have taken, who were students with me, became instructors. Similarly, I was also a student with someone, I became an instructor, and that applies to every industry, right? So example, even if you look at the schools, the teachers who are teaching as of now, they would also be students of some teachers sometime in the past. So that's something which is going to happen in every stream. So there is nothing exceptional about it. But yes, now if you think about it, how did they become or came to a level where now they can also be instructors? They followed this, right? Very, very important. So again, that brings us to the end of today's session. Thank you so much for joining in. I'll be seeing you next Sunday. Till then, trade safe, enjoy your Sunday. Bye bye.